Hi everyone, I'm Chad Shoop, the editor of Automatic Profits Alert, and we all have that friend or family member who's just late to everything. They can't be on time to save their life. Whether it's their wedding, whether it's dinner, whether it's a birthday party, it doesn't matter. Work, school, it doesn't matter. These people just are always late, and they've been late their whole lives, and we know who they are, so we end up planning for that. We tell them to be there 30 minutes early just so we know they get there on time. Well, in the stock market, the Federal Reserve is that person. They are always late to the party. They're always behind the curve when it comes to when they should be adjusting rates. Now, if you don't know, the Federal Reserve uses interest rates to help manage our economy. So if things get overheated, if financial assets get too stretched, they can increase interest rates and it'll kind of cool things down. And the whole goal is to keep inflation tame. Now, inflation is the measure of prices. So as prices go up for things that we buy, like cars, groceries, gas, all those things, as those prices go up, our standard of living goes down if we're not getting higher pay. So if inflation's at 2% and we're growing our pay by 2% a year, then we're staying right in line with inflation and we're keeping our same standard of living. Now, if inflation goes up to 10% and we're only going up 2% in pay a year, now you actually are falling behind the current pace of the environment, and now you're below your standard of living that you were the year before. Even though you're making 2% more money, it's because everything else costs 10% more. So the Fed, their main goal is to keep inflation tame. Now, every single time that they're watching inflation, they react late. They're never early. They never react on time. When you go back to the housing collapse that we had, they were late. They let their easy money policies with lower interest rates and trying to stimulate an economy that was already heating up. And that's how we got the financial asset bubble, that along with some other lending requirements that were in the works. But that all fueled the asset bubble that we saw that rolled over in 2007 that led to the Great Recession that we had during 2008. Now, they were late to increase interest rates, to tighten monetary policy, to slow that asset bubble a little bit, and then they were late to react to drop interest rates to ease our recession and to boost our economy. So they reacted a little late on both of those, and that's why it's taken longer to recover, and that's why it was, we had such a big recession during that time. And now here we are again. They're late to increase interest rates. Our economy is overheating, and that's not in a sense of growth, but in the sense of it's at full employment. Unemployment is extremely low, and that's going to push wages higher. So wage pressures are going to go up. That increases inflation. We have the tax reform. That's going to boost the economy as well, and that's going to increase some inflation in our overall economy. Trump's imposing tariffs on broad items like steel, and that's going to increase prices in general. And it's not much, but it does increase prices in general for our economy. Now, all of those things are going to play effect into inflation going up over the next year or so. Now, all of those signs are present. But the Federal Reserve, they met the other week, and they said that there's really no signs of inflation currently in the data. And of course there isn't. It's not really here yet, but it is all coming, and it's all right there in front of us. All of the ingredients are there to make inflation really turn up over the next year or so. So it's not going to take long, but yet the Fed is still increasing rates at their slow quarter-of-a-point pace. And interest rates right now are around 1.5% to 1.75%. That's their new Fed funds target rate. So that's still extremely low, and that's still stimulating the economy a little bit. Yes, it's higher than it was a year ago, 2 years ago, but it's still an easy money policy that encourages lending because, if you're putting your money in a bank to earn 1.5%, that's not really, that's not really exciting. You'd rather put your money in the stock markets and other things still. So until that rate gets up to 4 or 5%, that's when we'll really see the crunch in the stock market. And that's going to happen when they see inflation start to turn up. Then they're going to have to react late, of course, and increase rates at a faster pace to 4 or 5% as their Fed funds target rate, which is beyond where they want to put it. But they're going to have to do that because the economy and inflation are really picking up and they don't want it to get out of control. So they got to do that to bring it back down to tame levels. Now, when they do that, which we're talking probably 2020 or 2021, when they do that, it's going to create a recession. And if it gets out of control and if they miscalculate anything, then it will create a Great Depression, the next one, and it's not going to be pretty. So that is something to prepare for. But there's a silver lining in all of this, and there's some really great news here. And that's the fact that the Fed is waiting on the data. The Fed's looking for the data to tell it that there is a lot of inflation in the economy. And that's going to take a year or two to play out. You know, all these things that are in place now, that's great. They'll start to see a little bit of inflation, but for it to really pick up, it's going to take a year or two. So that means that our bull market is not over yet. It's still going to run for at least another year or two, and I think this is going to be the strongest run that it's had yet. It's going to be a very euphoric rise. There's going to be a great opportunity here to make a lot of money. So if you haven't yet, now's a great time to be invested in the stock market, and we're going to benefit from the next year or two from this big boom in asset prices. And then after that, then we'll manage it from there, and we'll look to get out and take our winnings and move on. Well, that's all for my video today. If you liked it, be sure to subscribe to our page, continue following us, and until next time, I'm Chad Shoop with Automatic Profits Alert.